The Fed just dropped its latest policy announcement, and it's quite a bit of a paradox. So let's dig into what's going on behind those numbers and the rate cut. First of all, the Fed chairman announced that economic activity moderated in the first half of this year, and the risks to unemployment have actually risen. So when we look at this, we would expect rate cuts, which is what we got. But when we study the summary of economic projections, there's a lot of conflicting data that we need to get into. First, let's look at growth, which was projected to be at 1.4% in the June projections and is now increased to 1.6%. So growth is actually on an upward trajectory, not really justifying a rate cut. Similarly, when we look at unemployment, the projections between June and September have not really changed. You're still seeing the Fed's projection at 4.5%, but the jobs data that has come out is showing a completely different picture. When we look at the inflation numbers, this also stands at 3%. There hasn't been a significant change between the June and September projections for this year. And lastly, when we look at the Fed funds rate, we see that the projection from 3.9% has come down to 3.6%. So what the Fed is actually expecting is that growth will be higher in the long run. Inflation will be higher in the long run. You're also expecting unemployment to stabilize in the long run, by which I mean beyond in the years 2026 to 28 and beyond. If everything is so rosy in the projections, then why are we looking at a rate cut today? Share your thoughts in the comments below.